Fed meeting is on Wednesday, but you, along with most other people, consider March to be a live meeting. But what happens after that? What is the path of Fed cuts? How many do you think we'll see? And how aggressive do you think that balance sheet runoff is going to be?
Okay, so here at Nomura, we are looking at 4 rate hikes this year, the first of those happening in March. I think the key thing for the FOMC meeting this week is signaling. And ultimately, forecasters will get more confident of their views once we get through to the end of the week, and that will give the market something to actually latch on to. So this week is quite critical.
So if things are more aggressive than perhaps the market is anticipating, what are the risks of another tantrum here? Is the stage set?
Well, I think it depends on which stock market, which clusters of stocks that you're looking at, the strength of companies' balance sheets. Ultimately, the companies which are most vulnerable to increasing rates are those companies which are on aggressive valuations, where the market is looking to value future cash flows on a high multiple. And typically that's driven by the cost of equity, which is influenced by the real rate. And ultimately, I think in the US, there's quite a lot of these companies. There's a lot of companies which are loss-making, which have got high valuations. Asia, on the other hand, which is the markets here at Nomura that we cover, we feel they are much more insulated from the Fed than those in the US.
What about not only the Fed influence, but also the PBOC influence? Because this GTV chart on the Bloomberg shows those huge southbound flows that we've seen recently in China, given expectations of perhaps a more easy monetary policy and fiscal policy around China.
Yes, I think in terms of the PBOC, I mean, unlike other central banks, the PBOC is more of a government agency. If you look at central banks in other parts of the world, including Japan, including the US, and including the UK, there is a perceived independence, in inverted commas, whereas the PBOC is simply another instrument of government power and works in tandem with other fiscal policy, for example. So I think from a top-down point of view, one of the things that the Chinese administration wants to continue with is a policy to ensure there is social cohesion and be mindful that the Chinese equity market, unlike others in Asia, is very much owned domestically. It's in the interest of the government to keep that market with a bit of energy behind it, simply because it is owned by domestic retail investors and their well-being and their comfort is a priority for the government.
This week, we're also watching, Jim, semiconductors earnings from SK Hynix, Samsung Electronics as well. What are you seeing on that front, and does that sort of change your outlook for certain geographies, given what's happening with chip makers?
Yeah, so I think there's a real disconnect between valuations we're seeing in the US for high-growth tech companies and what we're seeing here in Asia. If you look at the Asian markets, so take MSCI, Asia ex-Japan, two of the biggest index constituents are Samsung Electronics and TSMC. Now, these companies are trading on very modest valuations compared to their cousins, let's say, in the US. And for that reason, even if these companies don't deliver what we perceive as fantastic results, there's always going to be some support for them because the valuation multiples are very modest. Now, TSMC, the Taiwanese constituent, which is 45% of that local index, this is a company which is growing its revenues at 20%, which is really quite extraordinary for a company which is fairly mature. It's been around for a long time. It's got a strong balance sheet and pays decent dividends, which are growing faster than inflation. So from that perspective, we've got a lot of comfort around the big tech names in Asia. I think where there is scope for disappointment is in some of the higher valued companies in the mid-cap space. So Chetan Seth, who's our equity strategist, he released a note this morning, and he was talking about the fact that in China and in India, you've got some of these mid-cap names which are trading on US-style valuations, and they could be vulnerable. But from an index point of view, they are so modest that if you look at the tech space holistically in Asia-Pacific, then actually I think it's trading on much more sensible valuations, and that gives us a great deal of comfort.